All right, hello again, dividend growth stock investors. My name is Colby, the DGI Crab, and today I just want to do a quick video here about the rule of 72. So some of you may already know about the rule of 72. For those of you that don't, I just want to go over it really quickly because it's so important for investors, especially dividend growth investors. And it's a major component of why I have structured this channel the way that I have, where I have selected 60 high quality dividend growth stocks with long track records of increasing their dividends year after year after year with consistency. So you can build up a passive income stream that will be steady and increasing over time. Now, before I go into anything else, I will just make that obligatory statement that I am not a professional, licensed professional financial advisor. The expressions and opinions in this video are just this one crab's opinion. So you should always do your own due diligence before you make a decision to invest any of your hard-earned capital into the market. But with that, I do want to just go ahead and get started. So the rule of 72, what exactly is it? Well, the rule of 72 is a pretty simple, it's not a totally perfect concept, but it's pretty close. So the idea is that you take the expected annual rate of return and you divide that rate of return by 72, and then the number that you get is the estimated amount of years that your investment should double over time. So, for example, an 8% annual rate of return would double every 9 years. 72 divided by 8 is 9, so 9 years. It's not totally perfect math, but it's very, very close math. So the higher the annual rate of return, obviously, the fewer the years it takes to double. So if you found something that went up by 25% every single year, then just about every 3 years, that investment's going to double. Now, 25% annual rate return would be amazing. I don't know too many people that are able to do that consistently year over year. But what I want to do here is take a couple of examples and talk about what those could look like over the long term. So first I want to look at Visa stock, which is in the tier 1 group of stocks, which I've organized for the 18 to 30-year-old investor. Visa currently yielding about, let's just say 0.75%. 5-year annual growth rate is just shy of 16%. So we'll say that that's a dividend combo factor of about 16%, just conservatively. Maybe we could say 17. Visa's been increasing the dividend consecutively for 15 years now. And then conversely, we'll look at Verizon, which is a much higher yielding stock. Right now, it's yielding about 6.5%. It has a 5-year dividend growth rate of just about 2%. And with Verizon, that's been very consistent. So that's, reason why I picked Verizon. Good starting yield, consistent growth rate. They've been doing it for 19 years. So if we were to take an investor who's about 20 years old, they're into dividend growth investing. They want to retire off of their dividend income one day. Well, I don't know about you, but when I was 20, I certainly wasn't making a ton of money. I was not investing either. Now, maybe if I had access to some apps like Robinhood or SoFi or Webull or some of the apps out there that make investing really easy and don't have any fees associated with them, maybe I would have been able to squirrel away $10 here, $20 there. But the idea, when you're younger, you don't have as much money to invest into the market. So if you're focusing on the really high yield stuff with fairly small dollar investments to you because you're excited about capturing that high yield, that the low overall growth rate isn't going to help you all that much. But then you might say, well, wait a minute, I'm going to reinvest all of my dividends. That's where I'll get all the growth. Well, yeah, sure. If you take the 6.5% yield and the 5-year growth rate of 2%, then you could have an annual rate of return of maybe 8.5%. I might even go as high as 9% potentially. But if we take a look at just a simple table that I put together here, let's say you're a 20-year-old investor and you cobble together $1,000 and you invest it into Visa with we'll say a 16% just conservatively annual rate of return with dividends reinvested along the way, versus Verizon with an 8% annual return rate, again with dividends reinvested along the way. Well, at age 20, if you put your 1,000 into Visa, which I think is a much better idea than something like Verizon, let's just say, then you're only going to have about $7 of forward income, which certainly isn't going to sound very exciting. Wow, $7 a year. But with Verizon, your $1,000 is going to get you $65 a year, almost 10 times as much. But if you think about it, $65 a year, what is that? That's nothing. $7 is nothing. $65 is nothing. Neither of those are even close to being at the point where you could retire off of your dividends. So if you let that $1,000 just sit, you don't invest any more capital into it, except for the dividends, at 16% annual rate of return, this dividend payout should double. And we're not even thinking about the stock price, not even taking stock price into consideration. We're just talking dividends here. Your annual growth rate should, or your doubling of your dividend should double every 4.5 years. And again, this isn't perfect math. We're just going to assume that Visa and Verizon both stay extremely consistent for the next 40 years. You could also look at it as maybe a collection of stocks that have similar rates of return versus one, but I just want to keep it simple and use these two, standard examples here. By 24.5 with Visa, you should have $14 of forward income. By 29, it goes up to 28, 33.5, 56, age 38, 112. And you could see this snowball effect that happens where it continues to double over the course of just 4.5-year increments. And by the time you're at age 60.5, you have $3,600 worth of annual income every single year. And at this point, maybe you are living off of your dividends and you're not doing the dividend reinvestment. And then at that point, you're still getting probably a 14 or a 15% annual growth rate on this number. So even if you're not reinvesting your 3,600 and you're living off of it, by the time you're 65, let's say, even without reinvesting dividends, I would think you would pretty comfortably be at about 7,000 a year. So your income continues to drastically go up even when you're at the point you're not reinvesting. And then if we look over here at the Verizon chart, like I said, we start out with $65 and we're reinvesting all along the way. Well, if that doubles just every 9 years, then at 29, we have $130. At 38, we have $260, which if you look over here at 38 with Visa, just $112 versus $260. So that Verizon investment's still ahead. But you'll see as you just continue to go along the track here, at 47, we have $520. At 47 with Visa, we have $450. So Visa's just about ready to turn the corner here, almost 30 years later. But again, this is what time horizon is all about. And then at 56, we've got $1,040. And then by the time we hit age 65, we've just gotten to the point where we're over $2,000. Whereas we have flown way past 2,000 at some point between age 56 and 60 with Visa due to those larger dividend increases. So while it may feel a little boring, it may feel a little frustrating for dividend investors who are young to put their money into these stocks that don't yield a whole lot right at the very beginning, over the course of the long haul, if you are holding and dripping, you're going to end up with much more dividends in the long run. And then by the time you are at the point that you are ready to retire off of the dividends, again, if you're not reinvesting them and you're living off of them, so long as you're not selling the underlying stock generating them, your income should still continue to, from these positions anyway, that you should have piled up in your younger years, they'll continue to double every 4 to 5 years. Whereas with something like Verizon, when you stop reinvesting the dividends and you're pulling them out to live off of, you're only getting a 2% annual rate of return on the growth, meaning that it'll take another 36 years for those dividends to double if you're not reinvesting them. So the idea is that, I want you to be able to retire off of your dividend income, but I want that dividend income for you to continue to grow year over year over year, even when you're not reinvesting the dividends. So that is the big reason, probably the biggest reason why this channel focuses on your age, why your age is so important, and why I've broken the stocks into 4 separate tiers. Tier 1 for your 18 to 30-year-olds, where you're getting a smaller rate of, or a smaller amount of dividends at the point of purchase, but a much faster, much more rapid rate of return. And if you're just starting out and you're at age 50 already and you don't have very much invested, well, something like Verizon is going to be a lot more effective for you, because you'll need to pile up that dividend income faster. You'll have to start with the higher yield stuff if you want to build up a portfolio that generates enough dividends for you to live off of. But if you're young, don't fall for the high yields, the excitement of getting those high yields early, because like I said, most of us in our 20s, we are not making enough money at that point to invest tens of thousands of dollars into the market each and every month, to the point where we could very quickly generate a portfolio that would give us enough dividends to live off of. And one final thought on that: even if you did come into a big pile of money at a young age and you wanted to put it into the market to live off of your dividends, if you're in your 20s and you put that money into something like Verizon, and let's say you have enough money that it can start generating $40,000, $50,000 a year worth of dividends, and you're just going to live off of those, again, it's only going to increase at a 2% clip every single year. Whereas with something like Visa, it's going to increase at a double-digit percentage year in and year out. So your annual raise is going to be a lot higher. So bear in mind what your age is, what your time horizon is, and what you really should be focusing on. The most important factor in my mind is the annual growth rate of those dividends. That and their safety and consistency, but the annual growth rate of the dividends is how you're going to retire, not only with dividend income, but a very stress-free amount of dividend income, where if we have a year of crazy inflation like we had this last year, or these last couple of years, you're probably going to be okay, because your dividends are going to be increasing by a 10% or more factor, versus loading up on stuff with very slow growth. It may not increase enough to keep up with inflation in the long run. So I hope that you all enjoyed the video. I have links in the description of this video to each of the 4 tiers, where I break down those stocks by your age range and what I think that you should be focusing on. Please feel free to like and subscribe, or leave me a comment below with your thoughts on the rule of 72. Until next time, everyone, this is Colby, the DGI Crab. Let's go get that passive income.